Hi, and welcome to The Full Perspective. I'm Charlie Thomas, the Content Director for the Insurance Insider, and each week I'm going to be talking to some of Insider Publishing's most senior staff to dissect some of the week's biggest stories. Today I'm joined by Insurance Insider's Editor-in-Chief, Adam McNestrie. Hi, Adam.
Hey, Charlie.
And Trading Risks Managing Editor, Fiona Robertson. Hi, Fiona.
Hi, Charlie.
Thanks for being with us, guys. We're going to kick off this week with the news that Nephila Capital has received in-principle approval to form a new follow-only syndicate. Syndicate 2358 is Nephila's second syndicate at Lloyd's following the launch of 2357 back in 2013 and sees Nephila expand into specialty risks, making a big departure from its historic focus on property cat. Fiona, what's your take here?
Yeah, well, I think it is that departure that's one of the most interesting things for me with this new syndicate launch. It has been a bigger trend within the ILS market over the past few years for some managers to start offering more diversifying strategies beyond catastrophe risk. So you have the likes of HSCM, Hiscox ILS, and also the other ILS fund that has a syndicate at Lloyd's, Arcus, has always done a bit more of specialty diversifying risk beyond the property cat sphere. But Nephila hasn't really done very much of that. So it's as much about who is doing this as what is being done, I think, for me. So that I think is quite an interesting development in terms of broadening out beyond that.
Yeah, I mean, you mentioned obviously this isn't the first time we've seen ILS players venture into Lloyd's, but the bulk of that ILS market is specialised in cat, which is where Lloyd's is already pretty saturated, right?
Yes, exactly. And I think that's probably a little bit of a barrier for any other managers who would be aspiring to try and get a platform at Lloyd's like Nephila and like Arcus or Credit Suisse have already done. I think probably Lloyd's is going to be more focused on trying to make it easier for existing syndicates to get ILS capacity in to support them. Their syndicates are very heavy users of retro on the catastrophe space, and that market is tightening at the moment. So I'm sure they'll be thinking about that in terms of trying to progress their capital plans.
It feels like something though that we've kind of seen before in some ways, right? Like people have been talking for a long time about Lloyd's as a possible means of connecting ILS investors with specialty insurance risk, or with primary insurance risk at least. And it doesn't really seem to have gotten that much purchase. You had the Securus syndicate. Securus had a corporate member business. Stonebridge has had a corporate member business. Beazley Beta was marketed to ILS investors, and actually much more of the money that's in and backs that business has come from sort of typical trade capital insurance companies. So I don't know. It feels a little bit like we've been here before. Yes,
I guess that's true. But then on the other hand, a lot of the Lloyd's syndicates just haven't tried yet within the ILS space, I think. There's only a few who've got sidecars and really, I guess, a couple who've got ILS businesses of their own at scale. So try again, I guess, until they get it right, perhaps.
Yeah, it's funny. It does seem like ILS and Lloyd's doesn't necessarily perfectly mix. It's like a cocktail where the ingredients aren't quite right.
This is the yeah, totally right. So I was going to say this is like the third example of a follow-only syndicate, I think, if I've got them right. So Adam, do you want to talk about what this means for that kind of lead-follow dynamic in general?
I think it is three, depending on how you count it, Charlie. So you've got Brit's key syndicate, the algorithmic follow-only syndicate. You've got the business that Beazley is working on with Christian Schwammer, wonderfully named Project Womble. And then you have this Nephila syndicate now. There are a couple of other things that are kind of forebears. The Beazley Beta syndicate, which is facilities only, and then Brit has this kind of analog follow-only structure as well, 2988, I think it is. But anyway, I suppose what's important here is you have a succession of these coming, and I think there's almost certainly going to be more to come. And if the market can find a way to make this work, or if participants in the market can find a way to make this work, it's potentially a really revolutionary change in the way in which Lloyd's works. Like the challenge of Lloyd's is all about trying to find a way to get the kind of many to one kind of to work for you rather than working against you. Lloyd's is one marketplace, but many different syndicates, many different capital backers. And at the moment, it's working against the marketplace where you have a lot of different underwriting entities with a lot of different duplicated cost. And if you can get this sort of lead follow principle to work differently, then you get a situation where the distribution can access a small number of sort of front end underwriters with lead capabilities, and then a lot of capacity the sort of many capacity can sit on the back end. And that kind of structure should be much more efficient for cost, and it should give Lloyd's really nice market presence because really big lines can go down very easily. If you can find a way to do that, it should reshape the Lloyd's landscape really dramatically, improve the value proposition, but also, potentially squeeze out a lot of smaller businesses or less successful businesses, probably a better way of putting it, because there's some very good small ones, and also push a lot of headcount out of the market, unfortunately. But this is kind of the cutting edge of the Lloyd's revolution right now.
Yeah, so I think I cut you off before, Fiona, when we were talking about Adam's point that it's like a cocktail where the ingredients don't quite mesh. Was there something else you wanted to bring in there?
Oh, I think I was just thinking that it is a little bit ironic that there is that perception, maybe, given that a lot of people also say that the Lloyd's market, some of its frameworks are just a sort of early replica, or the ILS market reimagined in a different form. So certain Lloyd's concepts like the 3-year accounting would lend themselves well to the ILS market. Names, it's third-party capital, just in a different format.
Yeah, people say names were the original third-party capital.
Yeah.
And then the sector kind of went back to the future after embracing corporate capital in the 90s.
Okay, well, let's leave that one there for now. But as Adam says, I'm sure we're going to expect more follow-only syndicates to appear in the near future. The second story I'm keen to get into this week is the major M&A news in the US wholesale market, which was the deal that was announced between RSG and All Risks. Adam, what's your take here?
I think the first thing to do here, by the way, is just step back and look at what Pat Ryan and Tim Turner have built in Ryan's Specialty Group. That business was founded maybe 10 years ago. And in that period of time, they've built a business, wholesale broking, and MGU business of real scale, which now has a presence in the reinsurance market via Ryan Re and Geneva Re. And I suppose it's rare that you see entrepreneurs build one business really successfully through multiple pieces of M&A and business building. Pat Ryan's done it twice. He did it with Aon in retail and reinsurance on a grand scale. Now he's doing it within US wholesale broking, which is a much smaller market, but he's built the number 2 US wholesaler inside a decade. And I think it's something like 30 M&A transactions in that period of time. So I think, first thing to say is just, there's plaudits are deserved for the business that's been built there within RSG. And this is just the latest example of that, and the biggest piece of deal making that they've done since they've been around.
Mm-hmm. And normally post-merger, especially one of that size, people will be talking about, well, where's the new startups going to come from? Where are the new challenges of disgruntled employees from the mega merger going to come from? But you don't think that's terribly likely in this case, reading between the lines on your Inside P&C piece this morning?
No, I actually don't. I think that we've tried to advance the idea that when you get enough consolidation within a space, and broking works very well for consolidation, you get a kind of countercurrent where people don't want to work for big corporations because the culture is wrong and they feel stifled and they're too leaden-footed, and instead they want to break free and they want to do something of their own and they want to be paid as entrepreneurs. And you've seen examples of that elsewhere. I think McGill & Partners is kind of the standout example, but say in reinsurance, for example, a little different, but you've got a reboot of Lockton Re again. So it's natural to ask, can we get a challenger broker within US wholesale, because you have this big 3 who have 80+% market share? I don't think it's as likely for 2 reasons primarily. So first reason, the retailers have almost engineered it this way. So you saw a process all through the 2010s where retailers took wholesale panels that could be dozens of wholesalers, and they thinned them out and they thinned them out and they thinned them out. They did these rationalization processes, and it kind of reached its height when, and they've rowed back on it a little bit, and I know Amwins is doing some with them now, but when Aon went to a preferred sort of wholesaler relationship with Ryan Specialty only. But anyway, that same process that's happened there has happened to a lesser degree elsewhere, with people having just 3 wholesalers or 2 or 5, and it's really squeezed out the smaller players and encouraged the consolidation. So I think the bigger retailers want it that way because it's more efficient and they can keep more of the economics if they have big bulk relationships. So I think it's very hard to get started as a wholesaler when all of the business is being funneled to these sort of three players that are the biggest and have the most capability and breadth. So that's one reason why. I think the other reason why is that some of the issues that you get in really big businesses, if you're thinking about, do I want to work for the combined Aon Willis? Some of the people who don't want to do that don't want to work for an organization with more than 100,000 staff members that is publicly listed, that has kind of all of the big company kind of apparatus and procedures and process. I think it's probably the case that it's not like that working at Amwins or working at RSG. They have either majority sort of staff and leadership ownership or a very large minority. And we're talking about, 2, 3, 4, 5,000 staff in these organizations. We're not talking about 50,000 staff. So I think they probably, in some sense, still feel like smaller businesses. They still feel entrepreneurial. And they're less likely to throw people out who are like, I've got to go and do my own thing. So I think I think we might see that these big three keep a kind of stranglehold on U.S. wholesale broking for a long time to come.
What about, I guess, the more business environment that they're facing in the near term? Do you think that for these wholesalers, is COVID going to bring a continuation of all the good, strong headwinds that they've been benefiting from the past few years in terms of pricing, or would they be more impacted on the volume side if there are any businesses that start where buyers are cutting back?
So I think, like you said, they had some really strong tailwinds over the last year or so. A lot of business has been dropped by the admitted markets and has moved through into the wholesale channel. And you've also had a real transition in terms of market rates. So there's been rates push commissions higher. So I think US wholesalers for 2019 were probably up anything from sort of 10 to 30% on the top line. It was a really big year for them. Now, what does COVID do to that set of dynamics? Well, it does complicate things. And it's definitely the case that in certain areas, sort of more on the casualty and financial line side, there's some downward pressure on volumes. But I think property is obviously held up very well. And two of the levers are still there. So you've got an offset from lower volumes, but you have rates that are moving up probably even more quickly now than they were before because they had a boost from COVID. And you also have more business that is likely to move into the surplus lines market because it can't be placed in the admitted market where carriers are being cautious. So I think wholesalers are better placed than retailers in terms of the growth that they're going to show. I think I spoke to one senior wholesale source and they said, think about wholesale broking for the year as being something like flat to plus 10, depending on who you are. I spoke to another senior wholesaler. And they said, well, we'd be surprised if we were only plus 10 for 2020. So I think there are areas, there are pockets of those businesses where they're down a lot, but there are other places that are compensating for it. And I still think it's a good environment for wholesale brokers.
Okay. Not many businesses that can say that this year.
Insurance is defensive, right? Insurance is a defensive sector, and if property BI losses don't bankrupt the market, and they wouldn't bankrupt the brokers anyway, then I can see why people who've got a kind of a broader eye on the macro market would say insurance is a good sector to bet on. And I think we're seeing some of that. Some of the new capital formation, I think, is partly people going, okay, where can we see a positive story for growth and margin expansion in 2021? Oh, in insurance.
Yeah, totally. You're definitely saying that with... Sorry, go on.
I was just going to say that this is not industry related, but I'm going to have to go and Google which one has the right maritime metaphor now, headwind or tailwind. So, yeah.
I'm not sure you'll like what you find when you Google.
Fair enough.
But no, I mean, the point you raise is what we've been sort of touching on in previous weeks of Full Perspective as well, right? Which is that there's an increase in PE money in particular, but you are seeing a wave of cash coming into our market through various sources, whether that's debt, equity, or PE involvement. And a lot of that is investors looking for a safe haven home or something that's looking like it will be a good bet in 2021. And insurance is traditionally one of those defensive stocks, along with telcos and mining and so on, which would be considerably seen as a decent bet in an economic downturn. So, yeah, I'm sure we'll see more of that as the weeks go by. Okay, well, that's all we've got time for today. Thank you so much for joining us, Adam and Fiona.
Thanks, Charlie.
Thank you.
And thank you guys for watching at home. Until next time, stay home, keep safe, and we hope you'll join us again soon for another episode of The Full Perspective.